Hello, everyone. I'm Ted Oakley, managing partner at Oxbow. And I have one of my favorite people here today because I always like people that have managed money and manage money now. They're different from the people that just write about it. And so we always have something in common, but it's Felix Zulauf. Felix has such a great resume that I can't even finish it really in a short period of time. But Felix has done a lot of things, managed a lot of money, a lot of places, world renowned. But Felix, glad to have you today.
Oh, it's my pleasure. Thank you very much for inviting me, Ted. It's a great honor to be your guest.
Let me ask you, Felix, just in kind of a twofold question, but starting with the political turmoil in the world, you always have a pretty good handle on what that looks like right now, the whole situation.
Well, I think the old world order that was unipolar and US centric over the last 30 years is really decaying because a lot of the weights in terms of economic influence and power and size and military power and political power and influence has changed and has shifted. And the US is trying to defend the old US centric unipolar order, of course, which is their own interest. And I understand that. But others disagree with that. So there came the Chinese, which is an uprising economy. It has its problems at the current time, and they have a lot to digest there. But it's a big power, and it's the biggest economy in terms of consumer products. They are the biggest market for cars and cell phones and washing machines or what have you is in China. And then there are others, like in Latin America or so, who see that the weightings are shifting, and that is a chance to get away from too tight leadership by the US. And therefore, it's a transition period leading most likely to a multilateral, a multipolar order in geopolitics. And that transition period is a period of turmoil and a period of war and a period of conflict, like there was between, before World War One to after World War Two. And that's the situation we are in. And I don't want to go into any details in Ukraine or Syria or what have you, but I think that's the situation we are in. And so far, the financial markets have not really paid a lot of attention to it, although it does impact economics. And we are coming to that now with the new US administration. Trump wants to make America great again, to be number one or stay number one or whatever, and he is going to use the stick that is called tariffs. And there is a problem with that because Europe has a mercantilistic economic model that is obsolete in such a world. China has done its homework to some degree. Their exports are about 20% of GDP, and 10% over the last few years they have channeled towards developing economies, third world economies, so that they are less impacted by the US tariffs. I think the guy at the biggest risk is Europe. Raising tariffs is a tricky thing. I looked at the history of US tariffs, and when you look at history of US tariffs, if Trump does what he said he would do, then we are in tariffs that lasted through the period from 1900 to 1945. And if he only does half of what he said, then it's the period from World War One, beginning of World War One to the end of World War Two. So I think we are talking about very challenging environment. And I think that's the situation we are entering. Of course, the exact timing of when that will hit markets, that's open to discuss.
But Felix, it's sort of like those beggar thy neighbor policies, back during the 30s and that sort of thing. And going back to that, and I don't think people today have been around long enough to, unless they know their history really, really well, what how that outcome can be more detrimental than not.
Yeah, you know, in 1929, the stock market was overvalued, and we had from the October peak, we had a medium-term correction. And then in June of 1930, the Smoot-Hawley Act was introduced, and that was tariffs. And that turned a medium-term correction into a bloodbath and a disaster for many years to come. So we should be aware of those risks. We are not in the 1930s or the late 20s, but we should be aware of those risks right now when everybody is talking about the rosy scenario for next year.
So coming back to the U.S., and I know, obviously I take your research and it's great, but how would you characterize, obviously in your research, and I agree with that completely, that you're in this mania bubble atmosphere, and those obviously your experience will tell you they can go on and on, but how do you see the U.S. market right now, stock market?
Well, the market is in excessive valuation territory, but the excessive valuation can get more excessive. And right now we have a situation where the economy is quite strong. The Atlanta Fed nowcast is suggesting, based on data released so far, that the fourth quarter will grow at 3.3% in real terms. That's a very strong number. The consensus is much lower, just around 2% or so. So we have a strong economy, and the Fed will probably cut rates again. And we have quality spreads that are not existent, very low, very depressed. Nothing points to a weak economy. And the exceptional situation in the US is, and we have never had it before, is really that labor demand is now above labor supply. And that's a new phenomenon, and it's only present in the US economy. And it probably is a result of many people before retirement age went into early retirement during the pandemic situation and the lockdowns. They had enough, and they had enough money to step aside. And this creates a strong employment market. It creates a household real income situation that is supportive for the economy. And that's exceptional. And that's why many of the leading indicators for the US economy that pointed to a recession and a slowdown have not really worked. So that could change, of course, in the future. My risk that I see is different. I see two major risks to the US economy. One is that Doji, Musk and Ramaswamy, that they are successful in cutting out a lot of government expenditures. If they just achieve half of what they said, it would deduct about 3.5% from GDP. We are now at about 3% growth rate. If you deduct 3%, you are down at zero. Then we have the trade situation. Trump will have a word with his major trading partners. And if he introduces trade tariffs, then of course the other side will do the same. They will not just sit quiet. And then we have a trade war. And trade wars are just the opposite of prosperity. They lead to a weaker economy for all. And this is the risk that I see. The other risk is that the US economy just continues to run and we go into a new inflationary cycle. I think that is coming later, 26, 27, 28.
Do you think, Felix, the basis of that spending in the U.S. is coming, or at least it looks that way to us, is coming from people from their stock portfolios? They've had these wonderful 2 or 3 years. They all feel better than they thought they ever would. And we see that particular group of people spending. That's where they're spending a lot, and spending a lot on their kids, everything.
Oh, absolutely. If the stock market goes down 15 to 20%, then I think it will stop and it would weaken the economy. So it's not that the economy is driving the stock market, it's the stock market driving the economy. And as long as there is liquidity coming into the stock market, it drives the economy, and the economy remains in robust. And it's not just stock prices, it's also Bitcoins. All those guys who have Bitcoins, all of a sudden they feel very rich and virtually overnight, so to speak. And of course, then you don't have to save as much as you had before. You can spend a little bit more, etc. And that's going on, and that can go on a while longer until the stock market corrects. And stock markets usually correct. Either there is an exogenous event, it could be geopolitical, it could come from the trade situation, or it is liquidity, that all of a sudden liquidity dries up because stock market bubbles ride on liquidity, and liquidity must continue to grow. Slowing liquidity is good enough to eventually prick the bubble. And I see that the decline in reverse repos in the Fed balance sheet, which was really the trick or the backdoor through which a lot of liquidity came into the financial system, has really come down over 2 trillion, and there are a few hundred billion left, but we are at the later stages of such a decline. Therefore, sometimes during 25, liquidity will dry up, and then we might face a problem.
And I wanted to ask you this too, Felix. If you look at, and we've run these numbers before on people in the industry, the money management industry, the investment side, and if you look at people under 45 or 46, it moves toward 40% of the industry is less than that age, meaning they've never seen higher interest rates, the times that you know about and I know about, the high interest rates, have never seen a serious long-term bear market. And how do you feel like that group would be able to handle both of those, higher rate, the whole thing?
I think that group will wake up in the next bear cycle when it hits, and it's probably only from late 25 or 26 on 26, 27, 28 will probably be very ugly years. And that means that all of a sudden their whole income and spending situation is turned upside down. And they are faced with it, and they react in a shock. And they will go into higher savings and less spending. And then we have a major calamity we are talking about. I think that is in the later part of the 20s. It's not in 25. I think it's too early for that.
And one of the things you're looking for, I think, is maybe a series of ups and downs,
Yeah.
15, 20%. And one of the things that the people in the industry today are not capable of, in my opinion, you can tell me what you think, they're not capable of trading, that have trading positions. And I think that's one thing we can do here at Oxbow. But how do you see that?
Well, trading is the most difficult thing in investments. Buy and hold is the easiest way. It is maybe difficult for those who look at the screen every hour, but it's the easiest for the average Joe. It's the easiest way to invest, and just let it run and disregard the ups and downs, etc. That's the best way. Trading really requires experience, requires talent, and requires an arsenal of tools that help you to get in when your gut say you should sell, and to get out when your gut say you should buy. So it's a tricky situation, and you have to familiarize yourself to be able to execute those things, because when you are at the medium term top, you're pretty lonely. You cannot ask your neighbor for advice, or the guy next door, or wherever. You cannot, because they are with the crowd, and the crowd is bullish when you should turn bearish, and vice versa. So it's very difficult. I don't think coming out from a low in 2009 after the disaster, and now having gone up for 15 years with interim corrections, but it's a 15-year run. That means people have learned the lesson. Whenever it goes down, you buy the dip. It's an easy thing. Whenever it comes down, it's a gift, and you have to take it. What they do not understand, at some point of time, there is going to come a major bear cycle, and then it doesn't go down 15% or so, then it goes down 50. And that's a different situation. Everybody who has traded and has had a serious losing position knows the feeling when your stomach turns inside out, you know.
Oh, yeah. Well, I say that because if I remember your history good enough, you were fairly lonely prior to the 1987 top, if I
That,
remember right.
yeah, yeah, that's correct. Yeah, that's correct. That was, but I was, at that time, I knew less than I know today. I was 37, a little bit cocky, and I thought I know everything. Of course, I didn't, but I had the guts to execute on my thoughts. And quite frankly, I think aggressive money management is much more a younger guy's business than an older guy's business. I think investing is more an older guy's business because there you bring the experience and all that of all your mistakes you made, etc. And I think that's the nature of the game.
Well, I say this question here because I think people just generally, just like you said, have been basically set up mentally to say, look, you never sell this market. You just don't sell it, and I think that's the problem you will have. And you always have some sort of serious decline at some point. And that's a problem I think you'll have. Just like you mentioned, they're not used to ever selling. So then they really get confused when you have a major market sell off.
Yeah, a granddaddy bear comes around every 15 to 20 years or so, and that's 50% or more down. I recall in 2007, I was speaking at the investment conference of a famous research institution from Canada in New York, and I was saying at that time we were trading at 1200 at the S&P, and I was saying we go down and see the 600 numbers, and people were shocked. And it went down to 666. And on March 6 in '09, I an interview with me was published with Barron's, and I said, I do not know where we will be in 12 months from now, but the next 3 to 6 months we will be up 25 to 40%. And when you travel from Dallas to Austin, all you need your headlights to show you the road that you can drive safely. You do not enlighten the whole road from Dallas to Austin. It's good enough to just see as far as it is safe, and that's the same about
Yeah.
investing.
Now, just switching a little bit, and I know you're generally in your research, you feel good about you feel like rising interest rates will be the norm the next 10 years in commodities. How do you feel about that right now?
Well, I think right now the upside in 10-year treasuries, as an example, is about 5%. I think we have an uptick here for the next few weeks into January, maybe back to around 450 or so. And then I think we decline again. Then I think we have the third medium-term decline from the high we had last year at 5%. And usually a cyclical bear market in yields has not more than three down legs. So it will be the last down leg, and it should bottom, let's say, before mid-year or something like that. And then we are at risk of another upcycle, and it would be the second upcycle in a new secular uptrend. And then we come to 5% again. And then the question is, will we break through or not? If we break through, it's a new paradigm. Then we have higher highs and higher lows and higher highs. And I think the Fed will then most likely try to go to yield curve control and stabilize everything around 5% or so. And that means, of course, money printing. And that means inflationary policies. and that means rising inflation, and that means further pressure, upside pressure on bonds, and eventually they have to let go, and it means a lower dollar also. So I think that's a scenario for 26, 26 and 27 will be very ugly for the bond markets. I think bond investors have another chance to get out probably in the second quarter or so.
But if your treasury maturities are short, I'm assuming what you're saying is you probably should keep them that way.
Absolutely. Yeah,
Yeah.
I think it's okay. Yeah.
How do you see, and I know you think you feel pretty good about commodities the next decade. How do you feel about that now?
The commodities are still a little bit soft because the world economy is very soft. The US is an exception to the rule. I mean, China is in a deflationary trap, and the numbers they publish are not reality. I mean, those are dictated numbers. I think the Chinese economy is closer to 1% growth, if at all, and has deflation and not inflation. The European situation is one of stagnation. And with that environment and the US, the only one with high growth, you cannot really paint a strong picture for commodities. What you need for commodities is you need major stimulus coming from the monetary and the fiscal side. And I think if we have a sell-off this year or a calamity due to tariff introduction or whatever, then you will see that the policies will swing to become more stimulative. I mean, most central banks, except the Japanese, are already in rate cutting mode, and they will continue. And I think if needed, they will eventually go and do fiscal spending despite the government finances that are in ugly conditions virtually around the industrialized world. So as soon as that stimulus comes, and I think that will come through sometimes in 25 or so, then I think you have the precondition for a good commodity bull market.
So, in that regard, I know you always have comments about gold and how you feel about gold. Do you own it? And if you had it, would you keep it? You know, and where are you on it?
I bought a big position in gold over 20 years ago in the early 2000, around 300 or slightly below. And I still own it and I keep it for the time being. It goes through ups and downs, but the uptrend is clear. We are in a secular bull market. Gold is money, and so-called cash money is credit. You know, that's a big differentiation. So gold has no liabilities, where all the other money has a liability somewhere. And I think that central banks are already cutting interest rates. They will do more, and I think in 25 you will see one after the other, probably beginning with the European Central Bank. They will go to QE. If I'm right on the economic situation. And if that's the case, that is a bullish support situation for gold. So I think the structural bull market in gold remains bullish. We are now at the upper end of a trend channel or whatever you have. And I think 2,800 or so is the upper end of the range, and 2,400 is the lower end. And I would be a buyer at 2,400. I'm not selling at 28 because I think we go higher next year and beyond.
Well, and I think that's what people have to remember when they buy gold is that it's going to move around some, you know, and there was a period just like you're talking about between 2011 and 15 where, you know, you just had to hold it. And people, I think they have to get there in the mindset, but the other side of this I wanted to ask you too is, I know you have been fairly neutral on oil, and energy. Where would you be on that now?
Well, based on what I said about the world economy, I think oil is pretty soft, and that oil didn't spike at all during the war activities in the Middle East tells you that the physical market is very well supplied. So I could see a little bit more downside going into 25. But I think we are coming in the low 60s, mid 60s. We are coming towards the end of the corrective or bear cycle in oil. And I think going forward with all the stimulus that I expect, sometimes to begin in 25 and going through 26 and 27, I think oil has an upside of 90. So my current view is downside low 60s, upside low 90s. That's what I would work with. If it gets really ugly, it could go a lot higher than 90 because the Green Deal doesn't work the way some of the people thought it should. And we depend much more on fossil fuels than the you know, the policymakers in many of the industrialized countries realized. And I think we will wake up in the next few years that oil eventually will go higher due to limited supply. We haven't drilled enough. We haven't looked for enough. We have now a soft patch in shale oil, which is bad for oil actually short term, but it's very bullish for oil medium term or looking out a year or two.
Well, and let me ask you this, Felix, as sort of a hypothetical question in a way, but you manage some large funds in your life, UBS and various places. And if you were running one of those today and you could do anywhere, go anywhere, do anything you wanted to do, how do you think you would structure it?
Well, I don't run outside money. I run my own family money in my family office.
But you have.
Yeah, I have, and I have been in the performance race for almost 40 years, so I know how it feels. And then, as a portfolio manager, you have to decide what game you are playing. Are you playing the relative game or are you playing the absolute
Yeah.
game?
Yeah.
And investors and investment clients, they want to be in the relative game on the way up and in the absolute game on the way down because they don't want
Yeah.
to lose.
I've,
And
I've I've always told portfolio managers here, I said, look, it won't make any difference if you tell somebody in their portfolio that they're down 20%, but the market's down 28. I said, that makes no sense to them.
that's right. George Soros once said to me, "You can't eat relative bread."
Exactly. That's so true.
So it really depends in what situation you are in. If I were in the performance race where you just have to beat the benchmarks, I would be maybe I would be in the upper range of the investment percentage, and I would be looking to start selling sometimes in January. I think we are very late in the medium-term game, and I would start selling in mid-January as soon as I see the signs coming in for a correction. Um, for the absolute performer, I would stay in, and I would most likely have important stops in the individual securities just to make sure that I lose only what I can afford and not more. The caveat for 25 is it is the fifth year in the decade, and the fifth year in the decade is the most bullish year according to the decennial pattern. And therefore the fifth wave is usually quite bullish. And of course, we have had two very bullish years, and the third very bullish year is uncommon. But 2015 was the exception with down, I think, 1% or so, but fifth years are usually good. First year and a half after the presidential election is usually not so good. So there are a lot of cross currents. And I think 25 will see a correction in the first few months and then going higher, probably to new highs into the second half or mid-year or summer or so. And then I think we have to decide whether a new bear market will start because it's too early for that, but that could be the point. And I tell you another thing, there are liquidity cycles. And as I said, we are late in the liquidity cycle. And I think the liquidity cycle will top out in 25. And as it tops out, 26 will be very bearish on the liquidity cycle, and that will bring us a down year.
So Felix, if you had to give advice to just to say the average investor out here in the world right now, just some general advice for that person, because they really need it right now, I think. I think they're caught up in a lot of things that probably would get them in trouble. But what advice would you give, just from a portfolio standpoint, to the average investor today?
Use common sense. Markets go up and down. The business is cyclical. When you have parabolic rises, as we have seen in the last few years, they usually do not correct by going sideways. And one excess in one direction usually leads to a correction to another excess in the other direction. So be aware of that and structure your portfolio accordingly, that you can live with a bigger correction that could be forthcoming.
Yeah, I think people forget about that, about a safety valve, that they have liquidity so that you're okay no matter what.
The last 2 years was managing opportunities. I think from now on forward, manage your risk. That is at least as important as managing the opportunities.
One last question, and I'm just curious how you see this, but if you see how the world has drifted into nothing but index funds and exchange traded funds, and how do you see that particular phenomenon affecting things when you have a really bad bear market? How do you see that particular group acting?
Well, you could have unrelenting selling that doesn't stop because people are getting out of their investments. They are reducing the risk in their portfolios, and that you can get selling after selling, irrelevant of the valuation, as we have seen buying irrelevant of the valuation. And let me say this, if you have an index fund, most of the money goes to a few stocks in the US. And the US stock market is now, in capitalization terms, waiting. It is now almost 3/4 of the world indexes, of the world index. That means 3/4 of the world is in one single market. If that is a bubble by itself, if you correct that, it is not going to be a 7% down. It is much more than that.
Yeah. That was what we would think about. Well, listen, Felix, I want to thank you for your time. I know you get asked to be on a lot of programs, and you're nice enough to give us a little time today, and we will have your website and how to get in touch with you. I'll say this because we take your research. You have great research, and your skills are great, and we appreciate you being on today.
Thank you so much, Ted, for having me. It's always an honor, and speaking to a seasoned investor who has performed very well over the years is always a pleasure.
Yeah.
And I hope that one day we will meet again in person.
Well, maybe in Florida first.
Okay, where are you in Florida?
Well, I'm not. I'm in Austin, but I know you come to Florida sometimes.
Okay.
We go there a lot. We're doing business over there, so we go a lot. So maybe we can see each other there. But listen, thanks so much, and we hope to see you again next year.
Great. I hope that too. Thank you very much, and all the best to you. Happy holidays.
You bet. Thanks. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.